This Fed move could cost you $4,200 a year. The Fed's recent rate hike has consumers wondering how it will impact their finances. With interest rates on the rise, borrowing is becoming more expensive. You'll learn how this affects your mortgage, credit cards, and savings. And with the 30-year mortgage rate at 6.55%, buying a home just got pricier. For example, a $400,000 mortgage will now cost around $2,500 per month, up from $2,000 last year. But that's not all. Adjustable rate mortgages will also see an increase. To put this into perspective, a $200,000 adjustable rate mortgage could see payments rise by $300 per month. Consider the case of John and Sarah, who recently purchased a $500,000 home with a 30-year mortgage at 6.25%. Their monthly payments will be around $3,100, which is $500 more than they anticipated. Back in 2008, when mortgage rates were around 6%, the housing market began to decline. We might see a similar trend this time around. Additionally, consider the second-order effect of higher mortgage rates on the overall economy. It could lead to a decrease in housing market activity, which in turn could affect the job market. For instance, a study by the National Association of Realtors found that for every 1% increase in mortgage rates, home sales decrease by around 8%. So what can you do? Consider refinancing to a fixed-rate mortgage or negotiating a better rate with your lender. Transitioning to the next section, we'll explore how rate hikes affect credit card debt. Shorts_candidate. True, shorts_alt_hook. Mortgage rates soar. But the part that surprised me most is what this does to your credit card debt. And I'm not just talking about the obvious increase in interest rates. You'll be shocked at how this can add up over time and what you can do to mitigate the effects. For instance, a single late payment can trigger a rate increase, making it even harder to pay off your debt. Find out how to avoid this trap in the next section, where we'll reveal a specific strategy that can help you save up to $1,000 per year on your credit card debt. So credit card interest rates are also on the rise. With the average credit card balance at $4,700, a 2% increase in interest rates could cost you an additional $94 per year. But it gets worse. Some credit cards have rates as high as 25%. To mitigate this, consider consolidating your debt into a lower interest loan or balance transfer credit card. For instance, a $2,000 credit card balance with 18% interest could be transferred to a card with 0% interest for 12 months, saving you around $300 in interest. Historically, credit card debt has been a major contributor to financial stress, and this rate hike will only exacerbate the issue. In fact, a study by the Federal Reserve found that credit card debt can lead to a decrease in credit scores, making it even harder to secure loans in the future. But what about the common misconception that credit card debt is only a problem for those with poor credit? The truth is, anyone can fall victim to high-interest debt, regardless of their credit score. For example, consider the case of Emily, who has excellent credit but still found herself struggling with credit card debt after a medical emergency. We'll explore more on this topic and provide actionable steps to protect your wallet, including a specific strategy that can help you pay off your credit card debt up to 50% faster. Shorts_candidate. True, shorts_alt_hook. Credit card debt explodes. And the impact on your savings might just be the most important part, because while it's true that higher interest rates can be a good thing for savers, there's a catch. You'll learn how to navigate this complex landscape and make the most of your savings, including a specific strategy that can help you earn up to 5% interest on your deposits. Find out how in the next section, where we'll reveal a little-known trick that can help you maximize your savings returns. But higher interest rates can actually be a good thing for savers. With savings account interest rates rising, you can earn more on your deposits. For example, a high-yield savings account with a 4% interest rate could earn you around $200 per year on a $5,000 deposit. However, inflation is still a concern. The current 3% inflation rate could erode your purchasing power. Consider the case of David, who has been saving for a down payment on a house. With the current interest rates, he can earn around $100 per month in interest, which can add up to $1,200 per year. But what about the second-order effect of inflation on his savings? If inflation rises to 4%, his purchasing power could decrease by around 10%, making it even harder to reach his goal. So, consider investing in inflation-indexed bonds or a diversified portfolio to protect your savings. Historically, investing in a mix of stocks and bonds has provided a higher return on investment than savings accounts alone. For instance, a study by the Investment Company Institute found that a diversified portfolio can provide a return of up to 7% per year, compared to the 2% return on a traditional savings account. Shorts_candidate. True, shorts_alt_hook. Savings rates skyrocket. And finally, what can you do about it? Consider the 50/30/20 rule. 50% of your income goes towards necessities, 30% towards discretionary spending, and 20% towards saving and debt repayment. With the current economic uncertainty, it's essential to review your budget and make adjustments accordingly. For instance, you could allocate an extra $500 per month towards debt repayment or savings. But what about the common misconception that budgeting has to be complicated? The truth is, it's quite simple. By taking control of your finances, you can mitigate the effects of rate hikes and come out ahead. In fact, a study by the National Foundation for Credit Counseling found that individuals who create a budget are more likely to achieve their financial goals. For example, consider the case of Michael, who was able to pay off $10,000 in credit card debt by following a simple budget and debt repayment plan. So, take the first step today and start building a budget that works for you. Consider using the 50/30/20 rule as a starting point, and then adjust as needed to fit your individual circumstances. Shorts_candidate. False. In conclusion, the recent Fed rate hike has significant implications for your finances. By understanding how it affects your mortgage, credit card debt, and savings, you can take actionable steps to protect your wallet. To recap, consider refinancing your mortgage, consolidating your credit card debt, and investing in inflation-indexed bonds to protect your savings. And most importantly, take control of your finances by creating a budget and sticking to it. As a final step, take the first 30 minutes today to review your budget and make adjustments accordingly. Then, schedule a meeting with a financial advisor to get personalized advice on how to navigate the current economic landscape. Your wallet will thank you. This is for education, not financial advice. Talk to a fiduciary for your situation. If this changed how you think about rate hikes, hit subscribe. I break down one of these every week.